Welcome, everyone. Today we are diving deep into understanding chart patterns, which is a very important skill if you want to make better trading decisions. By the time we finish today, you will know how to spot the most common chart patterns, what these patterns tell you, and how to use them to improve your trading strategy. We will take this step by step, so stick around, and I promise this will make a lot more sense by the end. Let us jump right in. Have you ever wondered if there was a way to predict where the market might be heading next? Well, chart patterns can help you do just that. Now you might be wondering, what exactly are chart patterns? Chart patterns are specific shapes and formations that form when a stock's price changes over time. These shapes can tell us a lot about what the market might do next. Imagine a chart as a kind of story that reveals how buyers and sellers are interacting with each other. When we recognize these shapes or patterns, it is almost like we are able to predict what might happen next. Think of it like a map that helps you navigate a road trip. If you understand the map well, you can make better choices about when to enter or exit a trade. Each pattern is like a clue that shows us what traders are thinking and how they are likely to react. Some patterns show us when the market is about to change direction. Others show us that the current trend is strong and may continue. And some patterns let us know that it is uncertain and we need to be cautious. By understanding and interpreting these patterns in detail, you can gain a significant edge in your trading strategy. Let us get into some more details on what these patterns actually look like. A chart pattern is not just a random shape, it has specific characteristics that make it recognizable. For example, a head and shoulders pattern has a very distinct look with three peaks, while a triangle pattern will have trend lines that converge. Each type of pattern has its own rules and guidelines that help us understand what is happening in the market. When we talk about reversal patterns, continuation patterns, or neutral patterns, we are referring to the different messages these patterns are telling us about what is likely to come next in terms of price movement. Understanding chart patterns takes practice, and it also takes knowing what makes each pattern work. For instance, reversal patterns are telling us that the market sentiment is shifting. This could be after a long uptrend or a downtrend, and the pattern shows us that the price is struggling to keep moving in that direction. Continuation patterns, on the other hand, show that the market has paused, but the overall trend remains strong. This pause often happens because traders are taking profits or waiting for more information before continuing in the same direction. Finally, neutral patterns are those that do not provide a clear direction until they are confirmed by additional price movement. There are many variations of these patterns, and each one gives us unique insights. For example, the flag pattern is often a continuation pattern that forms after a strong movement in price, and it looks like a small rectangular consolidation. This tells us that even though the market took a small pause, it is likely to continue moving in the same direction. Recognizing these different nuances is what makes understanding chart patterns so powerful in trading. When you see these patterns forming on a chart, think of them as opportunities to understand what traders are thinking and how they are positioned. Is the market getting tired and ready to reverse? Is it just taking a breath before another big push? Or is it stuck, waiting for more information? The more you understand these patterns, the better you will be at answering these questions and making the right trading decisions. There are three big types of chart patterns that traders look for. First, we have patterns called reversal patterns. These let us know when a current trend, whether it is going up or going down, is about to change direction. Second, we have continuation patterns, which tell us that after a small pause or break, the price is likely to continue moving in the same direction it was before. And finally, we have neutral patterns, which could mean the price may move either up or down, depending on other signals. These are trickier and require more confirmation before we act on them. Let us start with those reversal patterns. One very famous one is the head and shoulders pattern. Picture this: after a strong rise in price, you see three peaks. The middle peak, which is called the head, is the tallest, while the other two, called the shoulders, are a bit lower. When the price breaks below what we call the neckline after that third peak, it often signals that the price is likely to go down. This is a very strong sign that the mood in the market is changing, and it can often indicate the beginning of a major shift from a bullish trend to a bearish one. Another common reversal pattern is the double top and double bottom. A double top happens when the price hits the same high point twice and then starts to drop, which can be a sign of an upcoming downtrend. This pattern essentially shows that the market tried twice to push higher but failed, indicating that the buying pressure has weakened. On the other side, a double bottom is when the price hits a low point twice and then moves up, signaling a possible uptrend. This pattern reflects that sellers were unable to push the price lower after two attempts, suggesting that the selling pressure is losing strength and buyers are gaining control. The inverse head and shoulders is similar to the regular head and shoulders, but happens at the bottom of a downward trend. It signals that prices may start to move up again. Picture a strong decline in price followed by three troughs, with the middle trough, the head, being the lowest. The other two are slightly higher and are called the shoulders. When the price breaks above the neckline, it often signals the end of a downtrend and the beginning of an uptrend. This pattern is one of the most reliable indicators of a bullish reversal, as it shows that the market sentiment is shifting from negative to positive. Another important reversal pattern to know is the rounding bottom, also called a saucer bottom. This pattern looks like a bowl or a rounded U shape and usually forms after a long downtrend. It shows a gradual shift from bearish to bullish sentiment. When the price breaks above the resistance level at the top of the rounding bottom, it signals a potential uptrend. This pattern typically develops over a longer period and indicates a steady, more reliable reversal compared to sharper reversal patterns. Then we have the triple top and triple bottom patterns. These are similar to the double top and double bottom, but instead of two peaks or troughs, there are three. A triple top occurs when the price hits the same resistance level 3 times without breaking through, suggesting strong selling pressure and indicating an upcoming downtrend. Conversely, a triple bottom forms when the price hits the same support level 3 times, signaling a likely uptrend. Triple tops and bottoms show strong indecision in the market before finally breaking out, making them powerful indicators of a reversal. These reversal patterns are crucial because they help traders identify when the market is losing momentum in its current direction and when a shift is likely. Recognizing these patterns gives you an opportunity to make trades at the beginning of a new trend, which can be highly profitable if executed correctly. All right, let us move on to continuation patterns. These are the ones that tell us a trend will probably keep going after a short rest. One very common continuation pattern is the triangle pattern. Now, there are 3 types of triangles to look out for. The first is the symmetrical triangle, where the price gets tighter and tighter between 2 converging trend lines. This tells us a breakout is coming, but it is not always clear which direction it will go. It reflects a balance between buyers and sellers, with neither side having enough power to force a definitive move until the final breakout. When the price finally breaks out of this pattern, it can lead to a strong move, but you need to watch carefully to see which direction it takes. Next, we have ascending triangles. This pattern forms when the price moves up to a level of resistance, meaning it keeps hitting a certain high price but does not break it, while the lows continue to get higher. This usually tells us that the buying pressure is building up, and an upward breakout is likely coming. It indicates that buyers are becoming stronger, and the pressure on the resistance level is increasing. When the breakout happens, it often leads to a strong upward movement, signaling a continuation of the bullish trend. The opposite of that is the descending triangle, where the highs are getting lower and lower, and the price keeps testing a horizontal support level. This pattern suggests that sellers are gradually taking control and pushing prices lower, while buyers struggle to hold the support line. Eventually, the support is likely to break, and the price will continue downward. This is a bearish continuation signal, and once the breakout occurs, it typically leads to a significant drop. Another continuation pattern to keep in mind is the flag and pennant. These patterns happen after a strong move in either direction, and they show a quick period of rest or consolidation before the price continues in the same direction. A flag looks like a small rectangular consolidation that slopes against the prevailing trend. It represents a brief pause as traders catch their breath after a large price movement. When the price breaks out of the flag, it usually continues in the same direction as the original trend, often with renewed strength. A pennant is very similar to a flag, but it has a slightly different shape. It looks like a small symmetrical triangle that forms after a strong move. Like the flag, it shows a period of consolidation, but instead of a rectangular shape, it has converging trend lines. This pattern also signals that the price will likely continue in the direction of the prior strong move. Flags and pennants are both short-term patterns, and they usually indicate that the momentum will resume after the brief consolidation. Another continuation pattern worth mentioning is the wedge pattern, which can sometimes be considered a continuation pattern depending on the context. A rising wedge can form in an uptrend, indicating that the trend is weakening and may reverse downward. But if it forms in a downtrend, it can be a continuation pattern suggesting further decline. Similarly, a falling wedge forms when the price is consolidating in a downtrend, and if it breaks out to the upside, it often signals a continuation of the downtrend. The key to interpreting wedges is to consider the trend leading up to the pattern and watch for volume as confirmation of the breakout direction. These continuation patterns are incredibly useful because they allow traders to get into trends that are already established. By recognizing when the market is just taking a rest, you can find opportunities to join the trend before it makes its next big move. Understanding these nuances can make a significant difference in identifying strong trades and timing your entry points effectively. Now let us take a closer look at neutral patterns. One of these is the rectangle pattern. This is when the price bounces between a high level and a low level without breaking either one. It can break out in either direction, which is why we call it neutral. It is very important to wait for confirmation before making a move. Another neutral pattern to look for is the wedge pattern. There are two kinds of wedges, rising and falling. A rising wedge tends to break downward, while a falling wedge often breaks upward. These patterns might seem small, but they can lead to some big moves when they are confirmed, so keep an eye out for them. Now, how do we actually confirm these chart patterns? One of the most important things to watch for is volume. Volume refers to the number of trades happening at a given time, and it serves as a very important clue to the strength of a price movement. For example, if the price is breaking out of a triangle pattern, there should be a significant increase in volume to confirm that the breakout is genuine. High volume indicates that a lot of traders are participating, which means the breakout is more likely to succeed. If the volume is low, it might be a false move or a weak breakout, and you need to be careful to avoid getting caught in a failed trade. Another key point is to always wait for confirmation before acting on any chart pattern. A pattern needs to be fully formed before you make your move. Do not jump into a trade just because you think you see a pattern starting to develop. For example, in the case of a double top, it is crucial to wait until the price falls below the support line, which confirms that the trend is reversing. If you act too soon, you risk entering a trade before the pattern is actually confirmed. Another helpful approach is to use multiple time frames when confirming patterns. This means that if you see a pattern forming on a daily chart, it is a good idea to check it against shorter time frames, like an hourly or even a 15-minute chart, to make sure the pattern is consistent across different time periods. Using multiple time frames can help you avoid false signals and improve your accuracy. Sometimes a pattern might look strong on a daily chart, but may not be as clear or confirmed on a shorter time frame. By doing this extra check, you can get a better overall picture of what is happening in the market and make more informed decisions. In addition to volume and multiple time frames, another confirmation tool is looking for price action around key levels, such as support and resistance. For instance, if a breakout is happening, you want to see the price staying above the previous resistance level after breaking it. This retest of a key level with strong volume is a great indication that the breakout is real and that the trend is likely to continue. Without this confirmation, there is a risk that the price might just fall back below that level, resulting in a failed breakout. Understanding candlestick formations can also help confirm chart patterns. Certain candlestick patterns, like bullish or bearish engulfing candles, can provide more evidence that the pattern is valid. For example, if you are waiting for confirmation of a head and shoulders pattern, a bearish engulfing candle at the neckline can be a strong signal that the price will move lower. In conclusion, confirming chart patterns involves looking at volume, waiting for complete formation, using multiple time frames, watching for price action around key levels, and understanding candlestick signals. These elements together provide a more reliable way to validate a pattern, giving you greater confidence when making a trading decision. All right, let us get into some strategies for trading with these chart patterns. One popular strategy is called breakout trading. In this strategy, you watch for the price to break above or below a key level like support or resistance. When that happens, you enter the trade, but only if the volume is high. The high volume confirms that there is real strength behind the breakout, increasing the likelihood that the move will continue. Set a stop loss, which is a level where you are willing to close the trade if it goes against you, just below the breakout point for long trades or above the breakout point for short trades. A stop loss is critical because it limits your losses if the market does not go your way. Another effective strategy is reversal trading. In this strategy, you try to catch the start of a new trend. For instance, if you see a double bottom forming after a downtrend, it signals a possible reversal, and you would enter a trade to go long, meaning you expect the price to rise. Similarly, if you see a double top forming after an uptrend, it signals a potential bearish reversal, and you would enter a trade to go short. In this strategy, you also want to set a stop loss below the most recent low for long trades or above the most recent high for short trades. This helps you manage risk in case the reversal does not hold. Always remember to set stop losses to manage risk effectively. In a breakout strategy, place the stop loss just below where the price broke out for long trades or above for short trades. In a reversal strategy, place it below the lowest point of the move for long trades or above the highest point for short trades. Stop losses are essential tools for managing risk, protecting your capital, and ensuring that a single trade does not cause significant financial damage. Another useful approach is to use a trailing stop loss in breakout or continuation trades. A trailing stop loss moves along with the price as it advances in your favor, locking in profits while allowing the trade room to grow. For example, if you are trading a strong uptrend, you can use a trailing stop to capture as much of the upward movement as possible without exiting the trade prematurely. This is particularly useful for riding trends that may continue for a longer period. In addition, combining chart patterns with other indicators can increase the reliability of your trades. For example, you could use moving averages to confirm a breakout. If the breakout occurs above a significant moving average, it adds strength to the signal. Using the Relative Strength Index, RSI, can also help determine if a reversal is likely. If you see a double bottom forming and the RSI shows the asset is oversold, it gives more confidence in entering a long trade. The Moving Average Convergence Divergence MACD can also be useful, as it helps confirm the momentum of the breakout or reversal. Using these strategies thoughtfully can significantly enhance your trading decisions. Breakout trading works best in strong trending environments where price levels are being tested repeatedly, and reversal trading is ideal when you have a clear sign that the market is about to change direction. Always use volume, stop losses, and additional indicators to confirm and manage your trades effectively. This way, you are not only increasing your chances of success, but also managing your risks prudently. Let us take a moment to cover some common mistakes to watch out for. One mistake that a lot of people make is jumping into a trade too early. This happens when you do not wait for a pattern to fully form. Always wait for confirmation. Another mistake is ignoring volume. Remember, volume is key to knowing whether a move is real or just a fake out. If there is no volume increase during a breakout, it might not last. Another common problem is overcomplicating things. Sometimes traders try too hard to see patterns that are not actually there. Stick to clear and obvious patterns. If you are not sure, it is better to wait. Another way to make your trading more accurate is to combine chart patterns with other indicators. For example, you can use something called moving averages to help confirm a trend. Moving averages are lines that show the average price over a certain period of time, and they can help you see whether a trend is strong or weakening. A simple moving average SMA or an exponential moving average EMA can be particularly useful in identifying trend direction and potential reversals. When the price moves above or below a significant moving average, it can indicate a potential change in trend direction. Another great tool is the Relative Strength Index, or RSI, which measures the speed and change of price movements. RSI can tell you whether a stock is overbought or oversold. If the RSI value is above 70, it indicates the stock may be overbought, suggesting that a reversal or pullback could be near. Conversely, if the RSI is below 30, it indicates that the stock may be oversold and a rebound could be expected. When using RSI with chart patterns, it can add an extra layer of confirmation, especially during breakouts or reversals. The Moving Average Convergence Divergence, or MACD, is another useful tool that traders use to understand momentum. MACD helps you figure out whether the momentum behind a move is strong or weak by comparing two moving averages of different lengths. When the MACD line crosses above the signal line, it indicates increasing bullish momentum, and when it crosses below, it signals bearish momentum. MACD is particularly helpful when combined with chart patterns, as it can confirm the strength of a breakout or a reversal. Bollinger Bands are another indicator you can use alongside chart patterns. These bands are plotted above and below a simple moving average and represent volatility. When the price moves close to the upper band, it indicates that the asset may be overbought, while movement near the lower band suggests it may be oversold. Bollinger Bands can help identify periods of high or low volatility and can be particularly useful in conjunction with patterns like triangles or wedges to assess whether a breakout is likely. Another effective tool is the stochastic oscillator, which helps determine if a stock is trading near its price range, high or low, over a specific period. This tool can be beneficial when used with chart patterns such as double tops or bottoms, providing insight into whether a price reversal is imminent. If the stochastic oscillator is above 80, it suggests that the stock is overbought, while a value below 20 suggests it is oversold. By combining chart patterns with these various technical indicators like moving averages, RSI, MACD, Bollinger Bands, and stochastic oscillators, you can increase the accuracy of your trading signals and have more confidence in your trades. Using multiple indicators helps you confirm the signals you are seeing and reduces the likelihood of acting on false signals. This multi-faceted approach to analysis allows you to make more informed and accurate trading decisions. Now, I want to talk a bit about the importance of practice. Mastering chart patterns does not happen overnight. The best thing you can do is practice. You can start with something called paper trading, where you practice trading without using real money. This lets you get comfortable with spotting patterns and making decisions without risking your cash. Another great way to get better is to study historical charts. Look at what happened in the past and see how patterns played out. This will help you get faster at spotting them in real time. To sum it all up, chart patterns are like a key to understanding what might happen next in the markets. Reversal patterns like the head and shoulders or double tops can help you spot trend changes. Continuation patterns like triangles and flags tell you that the trend is probably going to keep going. To be successful, start by learning the most common patterns. Use things like volume and indicators to confirm, and never rush in without confirmation. Keep practicing and building your skills. Mastering these patterns takes time and patience, but with enough practice, you will start to see the opportunities. Keep practicing, stay observant, and do not be afraid to ask questions or share your thoughts. This is a skill that gets better the more you use it. Thanks for sticking with me today, and keep working towards mastering those chart patterns. Happy learning and happy trading.